Hello, this is Kopi Time, podcast series on markets and economies from DBS Group Research. I'm Taimur Bek, Chief Economist, welcoming you to our 148th episode. Today, we'll discuss an asset class that has never been covered in the history of this podcast series. We'll delve into the world of private debt, away from bank loans and corporate debt, and we will discuss this world with Meghan Neenan, Managing Director and the North American Head of Non-Bank Financial Institutions at Fitch. Her coverage includes investment managers, business development companies, consumer and finance companies, leasing companies, securities firms, and financial market infrastructure companies. Meghan Neenan, welcome to Kopi Time.
Thanks very much for having me.
It's great to have you. We will start with the basics. Meghan, how is private credit different from bank loans and corporate bonds?
Sure. Yeah. Private credit basically removes the banks entirely as part of the process. So the private credit provider will interface directly with the company or the sponsor that's seeking the loan. When banks are involved, they tend to originate the loan and then they syndicate it or sell it to investors. And if there's a credit issue with the borrower, fixing the problem can be difficult because you have a lot of people that you need to kind of herd to kind of get on board with any kind of restructuring. So in the private credit world, you're often dealing with a single lender or a small group of lenders who tend to be very like-minded individuals. And so it tends to be a little bit easier to kind of work with the borrower to restructure the loan if there's any kind of issue. So banks completely not involved in the private credit space.
And the process of underwriting, credit risk assessment, actual disbursement, intermediaries, are those things fundamentally different or not that different than, say, a bank loan?
No, I don't think it's different really much at all. I mean, they still have their own underwriting criteria. Look, a lot of people that are in private credit space have got their start in a bank kind of for a long period of time. And so you certainly see that in a lot of the alt managers in the business development company. So it is very much a credit kind of mindset. They have an underwriting, philosophy and policy that they kind of operate with. And they have the infrastructure that they need in order to distribute, to monitor the loan performance, to work out the loan performance if there's any kind of issue. So it really is a full-fledged credit shop that they're dealing with.
And from the Fed's perspective, is the data around private credit ample? Is it reported with some degree of frequency? Are there certain regulatory requirements for reporting?
So it depends on the sector that you're talking about. Business development companies, which is one of the sectors we cover, it's actually the biggest sector we cover. We have 30 BDCs that we rate publicly. They are a little unique. They're just a U.S. construct. They've been around since the 1980s, actually, but they have to file with the SEC. And so they have to, they file Ks and Qs, everything. And a lot of them are public, some are private, but still they have to file with the SEC. And they actually have a decent amount of data in their filing. So they have to list every company that they're invested in, where they're lending in the capital structure. So first lien, second lien, sub debt, equity, whatever that is. They say what the maturity of the loan is, what the spread is that they're earning. They have the cost basis, and they also have the fair value. So they're required to mark their portfolio to fair value on a quarterly basis. So BDCs have ample information in their filings. Beyond that, a lot of those strategies that the BDCs do can be replicated elsewhere for an alternative investment manager, for example. So a Blackstone has a BDC, but they also have direct lending funds and SMAs, separately managed accounts. So the direct lending funds and the SMAs, there's not going to be any transparency around what's in there, except that if a BDC is investing in something, typically they will internally syndicate the deal amongst different funds, in-house. But there is not a lot of detail. And so I think that's why there's a lot of talk about private credit, because in a lot of instances, there's not a lot of information about what's going on. And so we're seeing a lot more push from regulators where they can on the insurance side and on the bank side, where insurance companies and banks have exposure to private credit. They're pushing for more disclosure around what those exposures are, so everyone can kind of get their head wrapped around what's going on in the sector.
Okay. And normally the investor side, I want to talk to you more about the types of investor, but just in the context of here, the reporting side, do the regulators also know who the lenders are, or they are only sort of focused on who are the borrowers?
No, I think they're definitely focused on the lenders as well, because you've seen so much growth on the lender side outside of the banking system. And so there is certainly some questions about what is the durability of that capital to the extent that there's disruptions, right? So can the corporate credit world keep functioning if there's a big market dislocation and some of these credit providers, aren't willing to kind of extend credit? So what happens just to the functioning of the general marketplace and economy? So It really is. I mean, the biggest alternative investment managers are the biggest players, certainly in private credit. So your Blackstones, KKR, Apollo, all the big names that you kind of would have heard of. And so if you go back in time, I think pre-GFC, kind of 2007, 2008, like a Blackstone, for instance, would have had less than $30 billion in their credit segment. Now it's over $250 billion. So that is a pattern that is, you see, replicated across all of the big players. So they have expanded significantly. A lot of them manage BDCs, like I talked about, but they also have direct lending funds. They have a myriad of credit strategies, right? Opportunistic, mezzanine, distressed. And now you're talking about, in terms of private credit, where the real growth engine we think now is going to be in asset-based finance. So that's something that they're certainly focused on as well. So those are the biggest kind of providers of private credit.
Okay. So you talked about the business development companies. Let's talk of the broader spectrum. So what are the types of borrowers there are in the private credit space? So sectors and geographies, and maybe, if you can even shed some light beyond the States, it'll be great too.
Sure. So Preqin, which is a data provider, has some estimates that they put there just out in terms of the size of the private credit space. So they're talking about 1.6 trillion or so at the end of 2024 is private credit. That's what they kind of capture. And they have that going to about 2.7 or so in the next 5 years. So lots of growth coming from it. In terms of 2024, about 50% of AUM is direct lending. So the majority of that is sponsor-based corporate loans. So a private equity firm buys a company, they need financing to do that, and they need, for the company. And that's a big portion of what's happening in direct lending. Preqin talks about some of the rest of that. The other 50% is things like fund of funds, mezzanine, special situations. We think that 1.6 probably understates what's really happening in private credit, because it excludes things like asset-based finance, which is going on. You have subscription facilities, NAV facilities, lots of things that could be bucketed within the private credit world. But within direct lending, that's kind of been around the longest. It's probably the easiest to understand, because it really is just lending to corporations, to companies of all sizes. And that's something that, because it's been around the longest, is the strategy that's been replicated the most meaningfully, I would say, in other geographies. So it is typical that something happens in the US, then, especially with the alt managers, then they move that strategy to Europe. And so you see a lot of that happening in Europe and APAC as well. And I think within APAC, Australia in particular has been a pretty good growth market for them. And so, like the business development companies, for example, Blackstone has something called Blackstone Private Credit Fund, BCRED. They have eCred, which is the European version of it, right? So they replicate those strategies in different markets. In terms of the underlying sectors, it runs the gamut, really. If you look at BDCs, which we think is kind of representative of the direct lending space in a lot of ways, the biggest exposures are business services, software, and healthcare. So those kind of are, I think, emblematic of what's happening in other direct lending strategies as well. I mean, I think they tend not to be looking at things that are very capital intensive. So like manufacturing and things you don't see a lot of. Retail has obviously had issues in the past, so you don't see a lot of exposure there. Energy, they used to be more invested in energy, and then you had the dislocation in 2015, 2016. They pulled back there. So they tend to look for non-cyclical businesses, cash flowing businesses without a lot of capital intensity. And so we get a lot of questions about, tariffs and things like that. And so far what we're hearing from earnings reports is, not expecting to have a big impact on those portfolios.
All right, Meghan, I was not going to bring in current affairs, but since you did, I'm going to ask you a question. I just saw this bid that Elon Musk made for OpenAI. Looking at the deal, I'm assuming you've seen it in the newspapers and stuff. Is it a typical thing that the private space would structure?
I don't know. I mean, I think that they're very big in kind of software and the next technology and things like that. But a lot of that stuff, any of those exposures, they need to make sure that they have in-house expertise in order to be able to do that. So the bigger shops definitely have sector teams that are focused and they have the expertise. And the big alt managers obviously have a lot of expertise on the private equity side as well. So they can leverage that knowledge across into the credit world as well. So having those internal resources are super helpful. So we see this a lot with, for example, like recurring revenue loans, which has been something that has been a big kind of driver and a big area of focus over the last 5 years or so, which is kind of in the software bucket. So you see a lot of competition there, and then that tends to lead to weaker terms and conditions. And then there's questions about how are those going to perform over time. So, I think that, I think those are any of those kind of situations can be interesting if they have the in-house expertise to kind of deal with the companies that they're looking at.
Right. So you talked briefly earlier about the investment structure, sort of that typify private debt. Could you elaborate on that a little bit? So typical contract between a private debt issuer and the borrower, how does it look?
It is very similar to what you would have in the bank world as
Okay.
well. So, I mean, like a first lien loan, for example, is typically a 5-year structure. There's it's SOFR plus the spread. In the middle market, there still would be covenants involved. You see the private credit world really kind of starting to blur the lines between, syndicated and private credit has kind of blurred. And so you see some of these big private credit providers who can kind of compete head on with the syndicated market. So some of those bigger deals have terms that are more similar to the syndicated market, meaning they could be covenant light. So you definitely see a lot of that, but it is very still traditional credit. I think that in the private credit space, the document, I think they believe tends to be tighter. You've seen some examples like a Pluralsight where there's questions about asset leakage, right? And the movement of collateral to different restricted subs or unrestricted subs. And I think the Pluralsight example is one that shows the documents perhaps are tighter and look to be tighter in the private credit space than in the broadly syndicated market, because they weren't just able to kind of take all these assets out and leave the lenders with nothing. So the philosophy is the same. I think the private credit providers would tell you the docs are tighter, and there's much more flexibility in terms of negotiating because you're not dealing with a broad syndicate. You're perhaps dealing with one lender or maybe a handful of lenders.
Okay, so I was kind of nudging you toward asking whether there's a regulatory arbitrage there or not. I think you're already sort of preempting and telling me that there probably isn't. But nonetheless, Meghan, I'm going to read you something from the Fed's November 2024 Financial Stability Survey. And there's a section on leverage risks, and it says the net issuance of institutional leverage loans, which has been particularly weak since 2022, was moderately positive in the third quarter. In contrast to traditional forms of business credit, private credit has grown quickly recently and constitutes about 7% of total outstanding non-financial corporate debt. So I suppose I'm going to ask you the same question in a different way. So what explains the dynamism in private credit?
Yeah, I mean, they certainly are growing faster, and a lot of that is just taking advantage of what the banks are doing or not doing. So really, with the GFC, you saw regulation step up on the banking world. That was the first real catalyst to see significant growth in the private credit space. Then you started to see, the rate rising cycle, that you just had more investor demand for higher yields, and investors were willing to take on a liquidity premium to get that higher yield, and so the private credit providers had that much more capital to kind of deploy into the space. And then you saw some of the bank failures, and you saw banks getting hung like with syndicated deals towards the end of 2022. So all of these little things have just juiced the engine a little bit in the private credit space, right? So they've been able to step in and fill the void over and over and over again. And that has led to increased comfort with the private credit space. So if you're a PE sponsor now, you don't say, oh, I'm just going to go to the syndicated market because the syndicated market is open. Now you dual track everything. You say, what is my private credit solution? What is my syndicated market solution? And then it's not necessarily just a pricing decision. It is, what's the flexibility? What else, ancillary things can I get from the private credit space in terms of knowledge of the market, which the banks can provide too. But if I need flexibility, if I want a delayed draw term loan, I know the private credit, lender might grow with me over time. If I'm looking to do a roll-up strategy and add on acquisitions over time, I know I can easily kind of restructure and add. And there's privacy here, right? So there just is more flexibility. And I think the private credit space has taken advantage of all of the, I don't say missteps on the bank side, but the regulatory pressure and things like that. They've been in the catbird seat, right? They've had the capital to deploy. And so they've been able to kind of step in and continue to grow. And so now with the syndicated market back open in the banks, last year in particular, you saw some restructuring of private credit deals by the banks and vice versa. So they can kind of function in harmony. But that's why I think certainly there's been more growth in the private credit space. They've just been more durable, certainly since the GFC.
on the point you made about flexibility, so like on private equity, for example, we know there's a minimum lock-in period, 5-7 years. Within that period, there isn't a lot of mark-to-market or clarity on how the investment is doing. But at the very beginning, there is a very strong assumption around the IRR, and investors sort of keep their money in the private equity fund if down the road they do deliver on that. So the returns on private debt is more of a fixed coupon and not as much of a lock-in as private equity.
Yeah, I mean, they're generally speaking, it's floating rate. So we saw the rate rising cycle, for example. So business development companies are, I think they're 85% or so first lien in their book. So floating rate security. So as we saw the interest rate rising cycle, you saw excess earnings coming from the BDCs. And then starting last year, the banks are coming back. There's much more competition. You saw spreads compressing. Now you've seen rates coming down. And so now, returns are coming down. So that is just they're going to kind of move with the ebbs and flows. But relative to their financing costs, they had locked in unsecured funding at a fixed rate for a period of time. So when rates were going up, they had a nice spread. Now that rates are coming down, you're starting to see them swap some of their fixed rate debt in order to kind of offset that as well to maintain some good margin. So there's going to be some variability, but I think investors understand kind of what those returns are. But the public BDCs, for example, they have a distribution requirement. They have had pretty steady dividends over time. And they've changed their distribution framework to have some variable component to it, recognizing that their earnings are going to move up and down a bit with the rate rising cycle, but also just, spread compression or expansion, depending on where we are in the cycle.
On the lending side, we see private wealth, for example, play almost as big a role as independent asset managers or large development companies that you mentioned. So on the private debt side, are we seeing sovereign wealth and private wealth becoming bigger and more consequential players?
Yes, definitely. I mean, sovereign wealth, pension funds, endowments, definitely increasing their exposure to private credit. And that's been happening for a while now. And that is because of the yield premium that they can get there. Retail is kind of this untapped frontier that we're starting to see more and more product being developed specifically for them. So business development companies are a great example. They're public for a long time. Most of them were publicly traded. In 2021, Blackstone launched a perpetual private structure. So it is a structure that is never going to be listed publicly. Instead, they offer quarterly redemption terms capped at 5% in order to give investors liquidity. It's targeted to the high net worth retail market. And actually, they had invented in 2015 really a REIT with the same structure. So they replicated that wrapper in the BDC space. And so these open-end perpetual vehicles now that are targeted to retail investors, you see having first it was real estate, then it was corporate loans. It's infrastructure now. It's private equity. It's secondaries. So they are looking to create products specifically to target the retail investors. And so you see these big alt managers having big private wealth distribution platforms because they want to access that. And certainly there continues to be talk of just being able to access 401k money, for example, in the US, these retirement funds. So how can they get there? And certainly with all the talk about like what happens with Social Security, whether or not it stays fully funded or not, are there private credit solutions or private asset solutions more generally that could help? It's really called the democratization of credit for retail investors. You definitely see that as a big focus.
Right. So Meghan, you mentioned rising rates and its implication on the returns. So I want to go back to that November 24 Fed survey. So there is this part where it says that the average interest coverage ratio at issuance for private credit is below 2, indicating debt servicing capacity in the range of below investment grade public firms. So, I mean, the way that sentence is structured, it's supposed to give one a sense of discomfort that there is not all that is not right there. There's some on the margin building up of stress. So what's your view to that observation by the Fed?
Yeah, I mean, we do think that there's a buildup of stress for sure. I think that credit performance in a lot of these direct lending vehicles have exceeded our expectations for a number of years, and particularly with the rate rising cycle. So I'll just give an example because they report the numbers, but Ares Capital, for example, if you go back to 2021, they're one of the biggest BDCs. Their underlying kind of interest coverage ratio for their portfolio was 3 times. And that kind of steadily trickled down until it bottomed at about 1.6 times during the rate rising cycle. Now you start to see it tick back up a little bit. I think it's back up to 1.9. But at the end of the day, I mean, these direct lenders are lending to sub-investment grade companies for the most part. So these are the BDCs are single B names or below. Now that you see some of these bigger firms kind of expanding and blurring the lines between the syndicated market and the private credit market, certainly you have some double B exposure in there too, potentially. But the rate rising cycle has certainly pressured interest coverage ratios. We have not seen as much in terms of the BDC portfolios credit losses as we would have expected, just given that cycle. Now we've seen some rate cuts, but now, I think that the picture there is a little bit less optimistic. So rates are going to be higher for longer. And we certainly expect that there's going to be pressure and credit defaults, especially for those that have the lower interest coverage ratios and have been on non-accrual or watch list for a long period of time. So definitely the ICR is something that we keep an eye on. And it's not really surprising the number that the Fed's quoting in terms of where it is. That's what we're seeing in the BDC portfolios as well.
Okay. All right. So let me go from the Fed's sort of cautious approach to slightly more alarmist approach. So this is Welcome Trust Nick Mokes. He said, I think I read this in Financial Times, that I think I quote, private credit accidents are waiting to happen. Is that too alarmist a position?
Well, it's a tough question, but it's interesting. It's good timing because we just put out a report on Monday, actually, at Fitch, talking about the systemic risk of private credit. And what our verdict is that we don't think it is a systemic risk yet, but there's definitely areas that we want to keep an eye on for sure. So I think the good news is, you mentioned private equity structures before, and a lot of what's happening so far in private credit is in PE-style drawdown funds. So there's no redemption terms there. They're locked in for a period of time. Public vehicles like BDCs that are publicly traded, there's no redemptions there, or these new open-end funds, which have redemption caps. So a lot of the open-end ones in the corporate market, in particular, the commercial loan market, they're capped at 5% a quarter. So we shouldn't see widespread need to kind of force sell assets to meet any kind of redemption requirements. And the BDCs in particular that are open-end, they have the ability to gate. So they could put the gates down if there was really a lot of pressure there. So I think that's the good news in terms of the structure. But there's certainly an evolution that is happening, right? We're in the midst of that. So there's going to be continued evolution in terms of the structures. You have a lot more retail investors that they're focused on. Retail investors need the ability to kind of get in and out of things. And now you see the asset-based finance, which is also kind of expanding. And so that'll be new structures that we don't even know yet, right? So all of this stuff is evolving. There's also a lot of interconnectedness now between the big players. So Blackstone might be financing a deal that Carlyle is doing and vice versa, right? So there is a lot more of that. I think within the Blackstone universe, though, for example, we get the question sometimes, is Blackstone financing its own deals? And the answer is a little. So they could be doing a little bit of it. It's not that they have none. But they would limit it so they could never control a tranche on the debt side. So they couldn't drive any kind of restructuring if there was an issue, because that would be a conflict of interest. So it's always below a certain threshold, so they're not doing that. The other issue, too, in terms of interconnectedness is a lot of the alt managers, some of them own insurance companies outright now. So Apollo owns Athene, KKR owns Global Atlantic, for example. Athene has now a lot of exposure to private credit assets that Apollo manages. So the insurance regulators are certainly focused on that. Are there conflicts of interest there? Is there single manager concentration? Are they getting too exposed to illiquid investments? So Fitch had put out a report not too long ago that a life insurance company that is affiliated with an alternative investment manager has 4 times as much level 3 investments in their portfolio than one that's not. So level 3 just means there's no market quote available. It's marked to model. It's probably more liquid, right? So insurance companies definitely looking for exposures there. And then finally, the bank exposures to the private credit space. So they're providing, warehouse lines, maybe finance subscription lines for private equity funds, NAV facilities for funds, things like that. So what are bank exposures? And interestingly, in the U.S., just in the last quarter, in call reports, regulatory call reports, the banks had to kind of start breaking out some of their disclosures in more granularity. Now it's like 5 lines that they have to kind of disclose. We just put out a report on that yesterday, just talking about that exposure from banks to private credit intermediaries. So regulators definitely just looking for more information and more granularity on what those exposures are.
Right. So this is definitely a tough question to answer, but I want to hear your thinking process on it, which is on the balance of risk. what would affect private credit more, a prolonged period of high interest rates or an outright recession?
Yeah, that's definitely a tough question. I mean, we've just gone through like a period of higher interest rates, right? And I would say it's been kind of with the backdrop of a pretty strong economy, right? So as I said before, the rates going up, there's pressure on interest coverage ratios, but from a credit perspective, most have outperformed our expectations. We still think there's going to be pressure. There's going to be higher losses as we look to this full kind of year 2025. So I think probably like a recession is something that the private credit space really has not dealt with yet, right? We haven't really had a true recession since the GFC, and private credit today is completely different than it was in 2007, 2008. So that's a little bit of a tougher question. I think a recession, it would be tough, certainly, because here, especially with rates going up, you still have strong EBITDA growth at the underlying portfolio company. So that's offsetting some of the pressure. If you have a recession, the EBITDA growth, the revenue growth is not going to be there. And so there's just that much more pressure on performance and asset quality and things like that. So I would say, generally speaking, a recession would be harder to deal with. But hopefully in a recession too, rates are coming down and that helps, mitigate some of that. But it really is going to depend, as in any recession, what are your exposures to different sectors that are more challenged than others, and how are you making through that? But it's a good question, and it's one we haven't seen really play out yet.
Right. But Meghan, personally, I will take high interest rates over recession any day, because I think, because high interest is either is there because there's high return on capital or because there is high inflation. So nominal expansion itself has a, like a denominator effect on various ratios. And even if some people's ICRs are down, there is stuff happening on the revenue side, on the market side. Whereas when there's recession, and I think the default risk likely to rise much more expeditiously than it would be in the high rates environment. So I sort of totally am with you on that side of the argument.
I'm glad I answered it correctly with an economist. I'm not an economist.
We have no idea where these things are going. And then of course, there's the third scenario, which is a stagflation scenario. God help us, if that is something that we have to deal with, high rates and a recession. So, Meghan, we've talked, tangentially a couple of times about private equity. I've seen some questions raised about the fact that there is a degree of circularity between private debt and private equity, that there are large alternative asset managers out there who have both wings, and then they sort of scratch each other's back. And that could be a source of sort of, unknown, if you will, as to what the systemic implications could be. You have any view on this?
Yeah, I mean, it's interesting because we call them alternative investment managers now. They used to be called private equity firms, right? They're not that anymore, because private equity, in a lot of cases, is one of their smaller segments now. So it really is private credit and real estate in some cases that have overtaken that. But yeah, I mean, there is. Look, I think alt managers, any asset manager, reputation is key. Their real assets are their people and their reputation, and so that's something that they need to protect. And so there's a lot of focus on how do we manage conflicts of interest, or even the perception of conflicts of interest. So I do think that they are ultra focused on that. I mentioned before, definitely there is some internally kind of financing of some deals potentially, but there is more like cross in terms of like a Blackstone financing a Carlyle deal and vice versa. So it is its own kind of ecosystem in a way, right? They're kind of financing their own deals, and it's really the bigger guys that are doing it, because a lot of these private equity deals that get done require very big financing checks, and so they need the big guys to be able to do that, especially if the syndicated market isn't going to be there for you. So there is a lot of circularity, and it's becoming more so with the interconnectedness that's growing, and it's the big guys get bigger, and so that is something that we're certainly focused on. But I think the big guys are also very, very much aware and focused on the fact that the reputation is the most important thing to them. And so I think they do what they can to try to avoid any kind of perception of conflicts.
All right. We've done quite a deep dive on the risks to private credit. I want to sort of switch it to the potential or the promise part of the discussion. There was a report from KKR, I think it was in Bloomberg. I may have shared this with you when we were having a back and forth on our preparation. KKR said something that is like an iPhone moment for credit, that solutions blending public and private credit, that's what's in demand. And whether it is AI or green transition, the huge fundings that we need both sides coming in together, and these blended structures are the things of the future. You wanna, sort of weigh in on that?
It does feel like it's moment in the sun for sure. I mean, it's interesting because I mentioned BDCs have been around since the 1980s. We've been covering BDCs here at Fitch since 2005. I joined in 2006. So in some ways, I've been kind of waiting around for to be able to talk about this a little bit more. So in some ways, it's great because we can point to the fact that a lot of these products have had some history, right? And even asset-based finance, it's not a new product per se. It's just that it's moving from the banking sector into the non-bank sector. But you have great credit minds in both places, right? But it really is, it is transforming just access to credit in a lot of ways, and for investors in particular, which I think is really the iPhone moment, right? So the democratization of credit is a real thing, and not just of credit, but of private assets in general. So getting people, my parents, right, mom and pops, access to these types of assets in a way that they can understand and that provides them still liquidity, the same way that an ETF would with the stock market connection. So it really is this transformational period where we're seeing a lot of growth, and I think that there's a long tail to this still. I still think we're kind of in early days because there's still a lot of untapped opportunities for sure, and you just see it with the growth and a lot of these the investor days that some of these alt managers have and the targets that they're putting out in terms of doubling AUM kind of in the next 5 years. It's really kind of staggering numbers. You see AUM in some of these alt managers over $1 trillion now, which used to be just the BlackRocks, right, on the traditional investment manager side, the Fidelities, those guys, and now you have these alt managers that are of a similar size, and they're not going to be alone. The other guys are all growing kind of at a similar pace, and that's going to continue. So it is an exciting time to be part of it, but it is a time to make sure you're digging in and really understanding everything that's under the hood, which can be challenging with the lack of transparency in certain parts. But we're in a great position at Fitch as a rating agency to really be able to kind of get in there and dig around and have access to the management teams and that information to help the market kind of digest what's going on.
It's absolutely fascinating. You mentioned mom and pop. Are we seeing private credit products manifest at the retail level?
Definitely, yes. I mean, BDCs a lot of them are publicly traded, so those anybody can kind of buy and sell those on the market. And then the perpetual structures are getting distributed through the wirehouses to retail investors. I mean, for the most part, they tend to be a little bit more focused on high net worth, but I think that's going to continue to come down and be a lot of people are going to have eligibility for those, and you're already seeing it really. So there's the announcement from Apollo kind of working with State Street about an ETF. They're looking to get some approval from regulators to launch an ETF that would be backed by private assets. So that's an interesting structure, would require probably some more liquidity on the back end for some of those assets that are backing that up. But that's something that a lot of them are pushing is, can there be a trading platform to provide liquidity for some of these private credit assets? And I certainly think with the minds that are behind it, that's going to be something that continues to develop and be in focus. So it's really a transformational time.
ETF was going to be my last follow-up question, but you preempted it, Meghan. Well done.
Sorry about that.
Hey, thank you so much for your time and insights. It was an absolutely fascinating discussion.
No, thanks for having us. Really appreciate it.
Great to have you, and thanks to our listeners and viewers as well. Kopi Time was produced by Ken Delbridge at Spy Studios. Violet Lee and Daisy Sharma provided additional assistance. It is for information only and does not represent any trade recommendations. All 148 episodes of Kopi Time are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.